In this week's update, shares upbeat despite ill winds from Hurricane Irma, UK inflation is on the minds at the Bank of England, and Apple gets ready for the most important product launch in the world. As the world rests just a little easier after another feared North Korean missile test failed to materialise last week, natural disasters have stepped up to test the nerve of markets. Secondary, of course, to the human tragedy and loss of life caused by Hurricanes Harvey and Irma is their potential economic impact, and that was the focus for markets at the start of the week. The signs are that investors are as relaxed about Category 5 hurricanes as they are about nuclear sabre rattling. Stock markets generally rose and safe havens dipped after markets digested the first damage caused by storms in the Caribbean and US. At time of writing, the S&P 500 is above its level from a week ago, ditto the FTSE 100, Euro Stoxx 50, Hang Seng Nikkei and the MSCI Emerging Markets Index. Gold dipped to $1,335 an ounce, and safe haven currencies, the yen and Swiss franc, weakened too after North Korea decided not to back up its nuclear test with a missile test as feared, and opted for an anniversary celebration instead. But as the fear of war has subsided, the threat from natural disasters has risen up to take its place. A hit to US GDP from the storms is expected, with Bank of America cutting its annual growth forecast for the third quarter by 0.4 percentage points to 2.5%. Estimates as to the monetary cost of the hurricanes vary greatly and clearly will depend on the path and strength of the storms from here. Morgan Stanley has put its finger in the wind, so to speak, and suggested that Hurricane Harvey could cost anywhere between $15 and $40 billion, while the bill for Irma is up between $20 and $65 billion. The immediate economic impacts of the storm have included almost a quarter of US oil refining capacity being knocked offline, while there is likely to be a dent in payroll data and a jump in unemployment insurance claims. Conversely, petrol sales are likely to be bumped higher in the short term as drivers filled up ahead of likely shortages and evacuation. The first statistical evidence of the impact could come in US retail sales data due on Friday. Why then the calmness for markets? The consensus among economists is that the effect of even historic disasters tends to be fleeting, with any immediate dip in economic data being recovered later as rebuilding efforts get underway. There were sector-specific impacts, with the US insurance sector index down 8.4% over a month at one point last week. But even here, there was a partial recovery on Friday as the worst fears of the damage eased. At the US Federal Reserve, monetary policymakers are likely to look through any adverse impacts on GDP from the storms. However, these impacts come amidst a backdrop of weakening inflation and may provide the Fed with an excuse not to raise rates. The central bank had scheduled another rise in rates this year, but recent noises from policymakers have been dovish, and markets now price just a 25% chance of this happening, down from 40% a month ago. This is helpful for shares, of course, and it's pushed the yield on benchmark US Treasuries to a 9-month low of 2.06% on Friday. It was felt by the dollar too, and on Friday, an index measuring the US currency against others from around the world slipped to a 33-month low, although it has recovered somewhat since then. The other currency news to watch this week concerns the Chinese renminbi, which weakened against the dollar after the Chinese authorities removed measures designed to curb short selling of the currency. Those measures were imposed 2 years ago as a means to bolster the renminbi, and the removal suggests that China now is more concerned with the hit a stronger currency will have on its exporters. Over to Europe, where the European Central Bank last week kept monetary policy on hold, but with hints from President Mario Draghi that the ECB could begin to trim its €60 billion a month bond buying programme from October. He confirmed that there had been, quote, very preliminary discussions about possible ways to limit the purchases. A potential obstacle to that would be weakening inflation in Europe, something not helped by the recent strength of the euro. President Draghi made this point, but the market reaction suggests that investors didn't really believe him and so bet on monetary tightening being the likely path anyway. The euro has now climbed to 110 against the pound. If the ECB does confirm a taper in October, Draghi will be very wary of triggering a rerun of the taper tantrum, the market wobble in 2013 that followed the US Federal Reserve's announcement that it would begin to slow its version of QE. As such, he was quick to remind markets that interest rates would not be changed until, quote, well past the horizon of net asset purchases, suggesting true normalising of rates in Europe is still some way off. Rates are also the focus in the UK this week as the Bank of England announces its latest decisions on Thursday. Ahead of its meeting, economists have suggested that now is finally the time that the bank takes a more hawkish turn after 8.5 years of ultra-loose policy. The rationale for that is that inflation is an increasing risk, despite the official consumer price index measure holding at 2.6% in July after a sequence of rises. The latest reading for August, which is published this week, in time for the Bank of England meeting, will shed more light. Whether or not the bank talks tough, there is little sign that markets are ready to buy it. In fact, the differences in outlook between the bank and investors is becoming pronounced. Despite the bank's repeated warnings about needing to raise rates sooner and faster than markets expect, markets are pricing in that they will stay at their current 0.25 level until the end of 2018 and not rise above 0.5% until 2021. Attention will be on the minutes of the meeting for clues as to the bank's thinking. Elsewhere in the UK economy, as well as news on rates and inflation this week, there's house price data from RICS on Thursday, as well as results from JD Sports, Morrisons and Wetherspoons, which could offer an insight into British consumer sentiment. Finally, more details of one of the most important product launches in years arrives this week, with details of Apple's iPhone X or iPhone X expected to be released. As by far the biggest selling product from the world's biggest company, the new iPhone matters, and if Apple can repeat the boost to its shares that typically follows the launch of a new iPhone, it could push Apple to become the first $1 trillion listed company. That's never certain, of course, and Apple needs to convince its loyal customers that a reported recommended retail price of $1,000 is justified. New features are expected, with the now familiar leak suggesting there'll be no home button, but an all-screen display instead, and face recognition to unlock the device.